Everyone's chasing tech stocks and hyped up growth plays, but here at Insightful Value, we like to look where others aren't. And right now, Karelia Tobacco Company looks unusually cheap. This isn't a stock you hear about every day, but maybe you should. Before we get into it, remember, this video is for informational and educational purposes only. It's not financial advice. Karelia Tobacco is Greece's largest cigarette manufacturer and one of the few truly independent tobacco companies still operating globally. The company has been around since 1888, and despite regulatory pressure and a shrinking global smoking market, Karelia has carved out a niche by focusing on premium products, solid branding, and strategic exports. It operates in over 65 countries with a strong presence in Europe, Asia, and the Middle East. Now let's talk value. Karelia trades at a very low PE ratio compared to industry peers, with a historically strong balance sheet and minimal debt. Its margins are enviable. Net profit margins consistently sit above 20%, and return on equity regularly beats 30%. That's rare, especially for a mid-cap tobacco stock. Revenue and earnings have shown slow but stable growth over the years, even with market headwinds. The most recent financials show revenue over $1 billion and net profits of around $250 million. That's not bad for a company most investors completely overlook. The real kicker? Dividends. Karelia is known for paying generous and consistent dividends. Over the past few years, payouts have steadily increased, and the current dividend yield is comfortably north of 7%. It's well covered by earnings and supported by strong free cash flow. For income investors, that's worth noticing. So why the low stock price? Well, sentiment around tobacco stocks is cold. Investors are cautious about regulatory risks, especially with the EU's tightening rules and global anti-smoking campaigns. ESG concerns also keep some funds away. Additionally, the stock isn't widely followed or held by large institutions, which means it's often mispriced or ignored altogether. But while sentiment is negative, the business remains strong. Karelia's ability to weather tough market conditions, maintain profitability, and return capital to shareholders is impressive. They've also started investing modestly in next-gen products, including heated tobacco and other alternatives, though it's too early to know if that will move the needle. Risks? Definitely. Tobacco is a declining industry. Consumer preferences are shifting, and governments are becoming more aggressive with regulation and taxation. Currency exposure is also a factor, as Karelia earns a big chunk of revenue from exports. But the company has been operating in this tough environment for decades and still delivering. For value-oriented investors looking for income and stability, Karelia might be worth a closer look. At Insightful Value, we dig up these underappreciated stories, breaking down the numbers so you don't have to wade through 10Ks or dense analyst reports. Whether you're just starting out or managing a portfolio, we're here to bring clarity and insight. If this breakdown helped you discover something new, hit that like button and subscribe. And head over to insightfulvalue.com for deeper research on Karelia and dozens of other undervalued stocks.